All right, so welcome. So we are excited that you guys are joining us this evening. And before we begin, we want to learn a little bit more about your event attendees. So if you guys have graduated from VCU, put your graduation year in the chat box. Let us know which program you graduated from. And we want to give everyone else a little bit of extra time to join this presentation. Also, if you are a current student, let us know when you're graduating and for what program. We want everyone to sit back, enjoy the show, take some notes. We're going to give everyone a couple minutes just to join in. But if you are here now and you are a graduate from VCU, put your graduation year and what program. And what if you are a student, what year do you plan to graduate and from what program?
Cool.
And we will be looking throughout the chat.
Okay, awesome.
All right.
Very cool. All right. Well, I'll go ahead and get started then, Tara, if that's good with you. You want me, or do you want to wait a little bit for everybody to respond in the chat?
Yes, give me about 1 more minute.
Okay, yeah, perfect. Yeah, take your time. I think we'll allow some more guests to get into the session too as well.
Yep. Thank you.
Yeah, no problem.
All right. Let's see here. Okay, someone graduated in 2017. All right. Perfect. I'm a 2012 graduate. So it's been a couple of years for me. School of Business.
Cool.
Yeah. Give everybody about a minute. Okay. All right. Class of 2012 School of Business. All right. Same here. This is awesome. Awesome. This is awesome. All right. Give everybody about 1 more minute just to join. And then I'll introduce myself and then we'll kick it off.
Okay.
All right, so I see we have some more people joining. I'm going to go ahead and introduce myself. So my name is Tierra Bird, and I am the Assistant Director of Alumni Lifelong Learning Programs at VCU Development and Alumni Relations. So we are super excited to have American Pacific Mortgage with us tonight. And before I turn it over to our wonderful presenter for today's conversation, just want to cover a few housekeeping points. We will be recording this event, so don't worry if you joined a little bit late or if you had to take a break. Everyone will receive a copy of the recording. Also, if you have questions throughout this presentation, feel free to use the Q&A feature, and I know the questions will be answered. It's going to be a lot of great information, and I'm excited that you guys are here attending this presentation. So, want to be respectful of everyone's time. I'm going to turn it over to Jason Mata with American Pacific Mortgage.
Okay, thank you so much, Tara. It's great to be with everyone in the VCU alumni family. This is our second workshop that we got a chance to present. We're joining you from California, so it's still a little early back here. But nonetheless, I'm so glad you took some time out of your probably busy evenings to join us this evening for today's discussion. So a little bit about me and kind of what we do with these workshops. We teach classes all across the country, and they're really designed and focused on education for first-time home buyers, because buying is probably going to be one of the largest investments you make in your lifetime. So we partner with various alumni across the country like VCU to help educate, train up, and coach future first-time home buyers to make sure they have all the tools and resources they need to succeed financially. So I've been in the mortgage industry for the last 20 plus years, and as one of the top origination teams, we get a chance to not only teach classes across the country, but help educate and then support clients through the home buying process. Because the goal is, once eventually you complete a class, that will hopefully be able to help you in the home buying process, whether that's this year or next year or whenever the time comes. At least you'll have all the right tools that you need to be able to take those next steps. So today's session is very interactive, so we encourage questions, as Tara mentioned earlier. So I'll be kind of taking those questions as we roll through tonight's content. Here's a little bit about what we're going to talk about this evening. So we're going to look at the housing market. What's it look like in the Virginia markets? We're going to speak a little bit about interest rates, because as you've probably read in the news with the changes in the inflationary markets, or the inflation in the markets right now, we're really seeing a really huge uptick in interest rates, and that's putting a little bit of pressure on what buying looks like for future home buyers. But it's also starting to level out the playing field when it comes to sales prices. So we're going to look at that in just a bit. Talk a little bit about credit. We'll look at qualifying when it comes to student loans. We'll look at various loan programs, as well as some of the income requirements and documentation for assets. We'll look at some assistance programs offered through the state of Virginia. And then we'll kind of wrap up tonight's discussion looking at the process of buying a house. So what does it look like to go from, being qualified or pre-approved to buy your house all the way to getting keys to your home? And then we'll kind of look at what a consultation looks like and to be pre-approved for a home purchase. So, as I mentioned earlier, this is probably going to be one of the largest investments you make in your lifetime. So, the fact that you're taking time out of your busy Thursday evening to kind of learn a little bit more about home buying is a huge step in the right direction, because, educating, getting the right resources around you is going to be really important as you make this financial decision. The benefits of buying a home come with, stability in your housing payment. This is going to be an asset, so potentially being able to pass along the asset to the heirs of your estate. As your home grows in value, and so many of our clients that we've helped over the last several years have seen massive growth in equity, which the equity is the difference in how much you owe on a house. So your mortgage balance versus what the market deems is the market value of your home. So that difference is what we call as home equity. And then finally, there's some tax benefits that still come with purchasing a home. So, when you buy a house, you could potentially have the deductibility of interest when it comes to buying a house. So as we kind of launch into home buying, I think a great place to start is talking a little bit about budgets. And so this next slide is our Freddie Mac rent versus buying calculator. And what this calculator does, it kind of does a side-by-side comparison for you in terms of what it looks like to continue to rent versus what it could look like as a home purchase. So this screen right here is on the Freddie Mac website. And by the way, this link, as well as all the material that we share with you in today's presentation, not only are we going to be recording the presentation today, but we're going to be sending you a copy of the presentation so you can have that as a resource for yourself. So let's kind of do just a look at, if I'm renting, what it could look like versus buying. Okay. And so we have to, as we set this up, we have to put a few kind of data inputs in here. Let's make some assumptions around rent. I'm going to go ahead and put, $800 a month in rent. I know that's going to vary for everyone based upon your situation, but let's go ahead and put $800 in rent. Let's say I have renter's insurance of $15 a month. And let's assume that rent goes up by maybe 3% a year. Right. And then we're going to plug in a home purchase. I know it's going to vary for everyone across Virginia. And by the way, we lend all across the country. So obviously in California will look a little different than Virginia or some of our other high cost of living markets. But let's say a $225 purchase price is where we're going to start at. Minimum down payment usually for $225 is 3%. So we're going to plug in 3% as our down payment. Property taxes, roughly about $2,500 per year would be the estimated property taxes. We're going to include in homeowners insurance. Homeowners insurance is going to protect your home against, theft, vandalism, some perils like flood potentially, anything like that would be part of your homeowners insurance. Maintenance of your house, so the upkeep, we want to factor that into our budget, because no longer, if something breaks down in our house, we can't contact our landlord to come fix an item. We're going to have to carve that out of our own monthly budget. So let's go ahead and add like $700 for maintenance. That could be obviously a little bit higher. And then in loan information, we're going to say 30-year fixed mortgage. Interest rates, which we're going to talk about in just the next few minutes, but let's assume about a 5.875% rate. That's about the average rate today. Origination charges, that's what your origination loan charges will be. With the American Pacific Mortgage Team, we have a $9.95 processing fee, underwriting fee, and a $9.10 processing fee. So those are all a part of your overall your cost of your origination. So if we let's go ahead and add that in. So that'd be what, 1905, I believe, like off the top of my head here. And then discount points. Generally, when we set up rate options for our clients, we don't include discount points, but discount points allow a buyer to be able to get a lower interest rate by paying additional costs. Typically, a discount point is equal to 1% of your loan amount. And paying that 1% of your loan amount can generally lower your interest rate by 0.25%. And then we have other settlement charges. Those are also known as part of the closing costs. And those vary based upon the transaction that you have with a seller, but we're going to go ahead and plug in $4,000 there. Now, let's go ahead and go ahead and plug in our appreciation rates. Okay, so let me go ahead and take you through the rest of these assumptions. So we're going to go ahead and plug in appreciation. That's going to be a big part of the equation here, because obviously buying versus renting is going to change things. So appreciation rates will vary. We like to create a nominal appreciation rate. We don't want to, assume that the home's going to continue to go up by, large amounts like we've seen in the last couple of years. So we're going to say a 3% appreciation rate. Expected years in the home, 7 years. The cost of selling a house. So when you purchase a home as a buyer, you're not responsible for realtor costs, but when you eventually sell a home, you will have that responsibility. And then we have state and federal taxes, as well as the savings rate. So we want to kind of plug that in. Now, it's interesting in this particular equation, when we look at the price point here and, we can, and versus the rent, it's right now showing that renting would actually make a little more sense here if we're paying that low of rent. But if I'm just going to, just for our discussion today, I'm going to raise that rent just a smidge to say maybe $1,000 in rent. So if we said $1,000 in rent and then we still buy at the 225 level, what that tells us is that, we would over 7 years save ourselves about $8,200 by buying versus renting. Now, when we look at the monthly payment, and that's part of our budget scenario, if you look at buying, your monthly payment is going to be about $1,800 a month versus $1,000 a month in rent. The trade-off that we're going to have to think through is that, we're going to have to increase our monthly budget, but potentially down the road with appreciation tax benefits, it could make more sense to buy. And that's going to be an individual decision for all of our future home buyers. As interest rates change, that affordability could look a little bit different. And we're going to talk about that in just a minute. Okay, so I'm going to switch this back to our slideshow here. Let me just go ahead and go back over there. Okay. All right, so that's our rent versus buying calculator. And now I want to kind of talk to you a little bit about the market as it relates to the housing market. And this slide kind of gives you a snapshot of what the housing appreciation has looked like. This has a little longer view. It pushes out up into the early 80s, but I want to kind of spend most of our time talking about what it looks like here in 2022, and really we'll say post-pandemic. As you can see here, the trajectory in the market after or when the pandemic hit, we really saw a pretty big movement in appreciation in homes. And that's not just for Virginia. We've seen across all markets across the country. Some higher cost of living markets have kind of a steeper trajectory here, but nonetheless, we've seen the housing market really increase. And the challenge that we've had, especially as we work with first-time buyers across the country, is when you have this swift appreciation here, prices go up so dramatically. Even though interest rates in 2020 were much lower, the cost of home and the competitiveness made it very difficult for first-time home buyers to get in the market. And what led to, that trajectory of appreciation? Well, we have less homes that are on the market because maybe sellers' fear of the pandemic and what that could do to the marketability of their home. We had a changing of, employment situation, more at home working. Many of you that are maybe joining tonight's discussion are working from home these days. And so, then that post kind of made a change in kind of desire for what maybe home life looks like for many future home buyers. So maybe they wanted to live in a home. And so we saw more of a demand there. And then the historically low interest rate environment also led to, a pretty big swift movement in purchases. Now we've seen a change in interest rates, and we're going to talk about that in just a second. And what we're finding kind of starting to happen right here is now we see this swift movement upwards in appreciation, but we're starting to see a little bit of softening. If we were to push this slide out a little further, we're starting to see the market kind of take a little bit of a turn right now. And so what I think that bodes well for us as future first-time buyers is we have the opportunity to be able to maybe enter the market at maybe a possible lower level or a less competitive level for our home purchase. Now, the difference in the market is interest rates. and interest rates are leading to a little bit of that softening because sellers were demanding top dollar for their homes. They had plenty of buyers that were willing to purchase their homes, but a couple things now, not all buyers are qualified when we're talking about interest rates are now in the 5 to 6% level. And, I think at the same time, these higher interest rates have maybe pushed buyers to maybe come back a little bit off the playing field, so to speak, and decide to maybe put things on hold to see what this market does. So I think at the same time, it does present an opportunity for first-time buyers if you are qualified and you feel like there's an affordable opportunity out there to be able to proceed into home ownership. And when we look at interest rates right now, and I'm going to go today's market. So today's market's about 5.875 to 6%, which is represented by the blue line here. So you can see we're kind of hitting the tip top here. The market right now remains very volatile in interest rates, and really what's driving this, and we all see it in our day-to-day, is the inflationary pressures we have in the market right now. So the cost of everything has gone up. We're at 40-year inflation highs right now, and the interest rates are feeling a lot of the pressure of that as well. So it's definitely changing the market. 2 years ago, we saw interest rates almost half of what they are today. So clearly interest rates have gone up, and it has changed affordability. We hope that with interest rates, maybe peaking at some point, and if home prices start to soften a little bit, at least level out, that will open new opportunities for some of our first-time buyers. In a rising rate environment like we've seen over the last 2 months, there is a product that starts to become a little bit more popular, if you will, and that's adjustable rate mortgages. And I like to comment on those because adjustable rate mortgages really aren't designed for first-time home buyers, but they can be attractive in a higher rate environment. What an adjustable rate mortgage is, it's a set fixed adjustable rate for a certain period of time. So in this particular slide, we have the 5-year fixed adjustable rate, which basically states that the rate is fixed for 5 years, and then after 5 years, it can adjust up higher. The benefit of a 5-year fixed loan, if it was a good fit for a buyer, is the ability to have a slightly lower interest rate. As you can see here, it's just a little bit lower. So instead of maybe a 6% loan, maybe I get a 5.25% rate loan. But the trade-off, or not maybe say a trade-off, but maybe the potential risk is that it's only fixed for 5 years. So we really don't recommend those products for first-time buyers because it just creates too much uncertainty down the road on what interest rates could look like for them. Now, not all interest rates are kind of created the same in terms of the structure of the interest rates, because it's not a one-size-fits-all for interest rates. Interest rates are based upon your credit eligibility, the type of loan program you're going to do, how much you finance, how much you put down for your down payment, and what the cost, or if you remember the discount points that we talked about earlier, will influence the cost of your interest rate. And finally, the term. Generally, most mortgages are at a 30-year fixed term. The lower your term is, generally that will lower the cost of your interest rate. And as we connect with you for a consultation to design, we call it a home buying game plan. We'll look at different interest rate options that fit your monthly budget. Okay, so one of the factors that goes into getting the best available interest rate is credit. And credit is a big component of getting financing in place for home buyers. There's usually two things that kind of hold back our buyers from being able to move forward in the purchase process. And it's either credit, because we've had some challenges in the past, or just assets for down payment. We'll talk a little bit about some assistance programs that are available for down payment. But when it comes to credit, one of the things we like to do as part of a consultation is to kind of take you through credit and just give you some ideas on how to improve credit, or just to maybe continue to follow the same path you're going down right now if you're in a great credit position. Every loan program has different minimum credit score requirements. So for an FHA loan, the minimum credit score is 580. Conventional loans, it's 620. VA loans for our veterans that have served is 620. And then for the Virginia Housing Program, we're going to talk about a little bit later, it's a minimum credit score of 640. So if we look at the FICO score calculation, and I know many of you that are joining us this evening have like different credit monitoring tools like Credit Karma or Experian or TransUnion, but there's basically a score calculation, and there's a weighting based upon certain parameters of the credit report, or characteristics of the credit report, I should say. 15% of the credit score is how long you've had credit. So the longer our credit is, the higher our potential credit score could be. 20% is going to be how much credit we have in use or new accounts established. But we also look at hard inquiries. So you've probably seen before on your Credit Karma, if you subscribe to that, that you really want to limit the number of hard inquiries. Now, as we start our consultative process, we only do a soft credit score, which does not impact your credit score. But most lenders will do a hard inquiry to begin the buying process. Now, 30% is going to be how much I owe on my credit balances or my credit utilization. So if I have $10,000 in credit limits, but I have maybe $5,000 in credit balances, that means I'm at 50% utilization. And so that's a pretty big part of the weighting of the credit score. It's almost a third of the credit score. And with credit utilization, ideally, you want to have that utilization be below 10%. So if you're maybe pushing up a little bit higher on your credit balances, maybe you're at 80%, we really want to kind of work towards getting below 50%. If we can improve upon that, like I said, we would want to get to 10%. The last component to the FICO score calculation is payment history. So basically how well we paid our bills, that's 35% of the weighting. When you have any type of late payments, it's factored as 30-day lates, 60-day lates, and 90-day plus delinquencies. Usually when you've had any type of challenges in the last 12 to 24 months, in terms of delinquent accounts, that's going to be the most impactful to your credit score. So you really want to try to maintain good quality payment history leading up to, qualifying for your financing. So things like bankruptcy, short sales, collections, late payments, those have all varying kind of levels of how long they're going to stay with your credit report. But generally in the last 12 to 24 months from that recent delinquency, that's where it's going to kind of most impact your credit score. Now, in working with clients during our consultations, we talked a little bit about credit utilization just a minute ago, but there's ways to kind of manage your credit utilization. And when we look at credit reports, the reporting from the credit issuers comes after the end of a billing cycle. So when you look at your credit cards, in fact, this is a great homework assignment as you leave today's discussion, is to take a look at each one of your credit cards. And they have a billing cycle end date, and they also have a due date. Now, at the end of the billing cycle date is when your credit card issuer sends out your credit balances to the credit reporting agency and says, okay, I have a balance of X, and whatever that balance is, that's going to influence your utilization. So what I encourage all of our students that come to our workshops is try to pay down your balances before the end of your billing cycle date, whether you pay them down or pay them off completely, because the lower you can keep that balance going into that billing cycle date, the better your potential credit score could be. So here's an example. So if I have a billing cycle that ends on the 20th of this month and I pay my account down or off by the 20th, let's say I do it on the 19th, but my due date's on the 4th. So if I've gotten in the habit of paying it down or off on the 4th of the month, problem is that I'm not getting the benefit in my credit score because the credit card issuer has already sent that balance out to the bureaus. So the switch would be to try to pay off or pay down the account by the 19th of the month. Then I'm going to have a lower credit balance, lower credit utilization, and hopefully my credit score will improve. So that's something that hopefully you can, kind of implement into your management of your credit cards if you haven't already done so. Account closure. So if you've closed out a credit account, you want to be really careful with that, because when you close out an account, it basically pulls away all the great history that you've had on that particular credit card. Not only does it affect the length of credit, but it also affects utilization, because you pull away one revolving credit card, then that takes away from your available credit, raises your utilization, and potentially lowers your credit score. And finally, when we look at credit scores in lending, we always look at the middle credit score of all the three agencies. So there's three reporting agencies. There's Equifax, Experian, and TransUnion. So if I have a 700, 680, and 660 score, the 680 score is what's going to be used for financing. So that's for me as my middle score. Now, if I have a partner that's going to apply with me and their scores are 700, 720, and 780, even though their middle score is a 720, because I have the lower middle score of a 680, that's a score that's going to be used from a qualifying perspective. Okay, so when we look at maybe past challenges we had, this is how long they're going to remain on your credit report. So usually credit inquiries, so hard inquiries, will be on your report for 2 years or less. Late payments, collections, judgments, those are all going to be 7 years. 10 years for bankruptcies, and then federal student challenge or federal student debts that are in lien status or collection status. Federal tax liens, those are going to be indefinite on your credit report. Now, if you've had any medical collections, there was just a new change in the credit laws. Medical collections will no longer show on a credit report, so just something to be aware of. So if you had maybe a copay they can get taken care of or whatever, and the healthcare provider try to put you into collections, those will no longer be appearing on your credit report. Now, another thing that does appear on credit reports, and many of you that are joining tonight's discussion are aware of student loans. And while student loans are in deferment or forbearance, I should say right now, as part of the CARES Act, they were just recently extended. We still have to count a minimum payment towards qualifying on a mortgage. And there's a couple different approaches to take based upon the loan product that we're doing. If you look at a credit report today, for most buyers that are in forbearance, it's going to show as a zero payment on your student loan payments. However, we do have to count a minimum payment against you for qualifying. So let's say I have $75,000 in student loan debt. The payments are $250 a month. That's the payment that we'll use towards your qualifying. Let's say that was the income-based repayment amount. If you're doing an FHA loan and you're not on an income-based repayment amount, the minimum payment that we'll use is 0.5%. For a conventional loan, it would be 1% of the balance. So it's really important that if we're on an income-based repayment amount, that we can use that, because that's going to be the lower payment for the qualifying. Okay, so and then with student loans, as we know, there's the forbearance that we just talked about. Now, if you're back in school and maybe you're on deferment, thanks, Ken. If you're in deferment because maybe you're back in school, we still have to count a minimum payment for you in qualifying. So regardless of forbearance or deferment, there still will need to be a payment that's counted towards the qualifying. Okay, so let's talk a little bit about different loan programs when it comes to first-time home buyers. These are like 5 of the core programs that are used for qualifying. Thank you so much. For qualifying, we usually look at conventional and FHA loans, but there's also our VA loans for veterans that have served. Our USDA loans are going to be for more rural areas of Virginia, and then jumbo loans, which usually require a minimum down payment of 10 to 15%. So we're going to spend most of our time talking a little bit about conventional and FHA loans, but we can also spend some time looking at some of the more of the outer core products that some first-time buyers will use. So with a conventional loan, I think we talked about this in our rent versus buying analysis. The minimum down payment is 3% for a conventional loan, and that's up to a loan amount of $647,200. So we can finance up to that full amount of loan. On a conventional loan, most people think that you have to put a minimum of 20% down. It's actually only 3% for first-time buyers. If you're a second-time buyer, it's 5%. For FHA loans, the minimum down payment is 3.5% up to a loan amount of $647,200. Now, when you put less than 20% down, there is PMI that is required, and that's called private mortgage insurance. And so I like to always kind of go through this slide with our attendees of our workshops, because it shows you kind of how mortgage insurance works between a conventional loan and an FHA loan. And because these are generally going to be the 2 core products that a first-time buyer will take a look at. With conventional mortgage insurance, there's a few different options to pay mortgage insurance when you put less than 20% down. You can pay it monthly. You can split the mortgage insurance up as a monthly amount plus an upfront amount. You can pay all of the mortgage insurance upfront. You can also build it into the cost of your interest rate. So let's say you have a 6% rate, but you're willing to take a slightly higher interest rate to buy out your mortgage insurance. You can do that with a conventional loan. And conventional loan mortgage insurance is based upon your credit score, how much you put down, and then how much you finance. So as going back to our credit discussion just a little bit ago, the higher we can get our credit score, the cheaper our maybe our interest rate offering could be, as well as our mortgage insurance opportunity. Now, with conventional mortgage insurance, once you have 20 to 22% equity in your home, as well as 2 years, you can apply to have your mortgage insurance canceled. And so that can be a really great benefit with the conventional PMI program. So let's look at an example here with a conventional loan. So let's say I bought a house for $300,000 and I'm going to put the minimum down of 3%. And so that would put my amount financed at $291. And if I assumed I have a credit score of 740 and that, like I said, that 3% down, my mortgage insurance is going to be about $97 a month. Okay. Now, if I take my credit score to maybe an 800 level, that mortgage insurance could even be lower. So something we always want to look to kind of optimize as we design our financing. Now with FHA loans, it's a little bit different because FHA loans have two components to mortgage insurance. There's monthly mortgage insurance, which is going to be 0.85% of the loan amount. And then there's upfront mortgage insurance, which is 1.75% of the loan amount. And that 1.75% gets added on to our amount financed. Now with FHA loans, as opposed to conventional loans, the mortgage insurance cannot be canceled. It only can be basically removed when you refinance from an FHA loan to another, maybe a new conventional loan. So here's what the calculation looks like for FHA PMI. So if we finance that same $300,000, we're going to, if we finance $300,000, we're going to add in the mortgage insurance on top of the amount financed. And so the PMI roughly would be about $208 per month. Plus, we would have the upfront PMI of $5,066. That gets added on to your amount finance. So it increases that $5,000 more than what you would see in a conventional loan. So, you may kind of step back and say, well, why would I even consider an FHA loan if conventional has, some better benefits? It really just depends because every buyer's situation is different, whether it's credit score, maybe it's, income qualifying, the amount of down payment. So it all kind of varies based upon our first-time home buyer situation. Now, as I mentioned in some of the loan program scenarios, there's different loan limits. And, if you look at the loan limits are based by county. So the higher cost of living counties that we have in Virginia will have higher loan limits. So it's 647,200 for Richmond, Virginia Beach, Chesterfield. You guys can see all the different counties there. As we get into Fredericksburg or Arlington, Clark, Fairfax, these are higher loan amounts. So these loan amounts are called high balance loan amounts. So they're designed to help more kind of higher cost of living buyers. So that are looking at more expensive markets. Okay, so now we're going to kind of transition a little bit. I want to talk to you a little bit about income qualifying, some of the documents that are needed when it comes to purchasing your home. So now so far at this point, we've kind of talked a little bit about budgets. We've looked at the environment when it comes to home appreciation and really kind of what the market conditions are with interest rates. We spent some time looking at loan programs and credit. And as we're designing our home buying game plan, there's documents that we're going to need to put together for our home purchase. So as a W-2 wage earner, it's pretty simple. So it's going to be usually the last 2 years of W-2s, your last 30 days of pay stubs, and usually some type of verification that we're going to complete as a lender. Now, for self-employed, it gets a little bit more cumbersome, so to speak. You're going to have the last 2 years of taxes. Depending on how your business is structured, we're going to need a profit and loss statement for a year to date, maybe a balance sheet, and then we're going to need to verify the business, whether it's a business license, maybe a CPA letter. So all those things we'll need to put together for your financing. Now, if you're maybe in a position where you have not only W-2 wage earner income, but you're self-employed as well, we'll need obviously, the tax returns for the business as well as the W-2 wage earner information. Now, it's really important to know that if you have both sources of income like that, you will need to show that you've been doing both the W-2 income as well as the self-employed income for the last 2 years consistently. So it's just something to keep in mind. If you do have, let's say, dual employment as a W-2 wage earner, we see this a lot in the healthcare industry. So if I'm working at one hospital for 20 hours a week, maybe 30 hours in another hospital, I'm going to have to show that I've been on both jobs consistently for the last 2 years. Now, in financing, it doesn't necessarily require a full 2-year employment history. For some of our new graduates, if you're just entering the workforce, for example, we don't necessarily have to have 2 years in the workforce. You can have a combination of education and employment to meet the 2 years. So one of the examples I give is, let's say I'm just graduating from VCU in the spring, or I just graduated in the spring from VCU is with an accounting degree. And now I'm going to get hired on an accounting firm. I begin my new job September 1st. If I have 4 years of undergrad, that undergrad, because I'm going to go work in the accounting field, is going to satisfy the 2-year job requirement that we would normally need for lending. Okay. Another question that comes up is for part-time income. If you do work some part-time income, we do have to show that you've been doing that part-time income for at least 2 years to use towards the qualifying. Okay. If you're transitioning jobs, this is another thing that kind of comes up. If you're maybe working for one particular employer right now, but you plan on making a job move, You can still do that with financing. We have to obviously look at what your projected income is going to be for the new job, and we could potentially use that for qualifying. Okay, taking still a look at income, there's a calculation that we use in lending. It's called the debt to income ratio calculation. What that does is it looks at your qualifying income versus your monthly expenses. And generally want to make sure that your expenses don't exceed 45% of your monthly income. And that's based upon the gross monthly income. Now, debt to income ratio is a calculation that we use for qualifying, but it's not necessarily an affordability calculation. So one of the things we'll do as part of a consultation with you is just kind of figure out what affordability looks like to you. So one of the first questions I ask our first-time home buyers is, tell me a little bit about your housing expense. Tell me about what you think your projected housing expense could look like, because it's our goal to design options for you that are going to fit that ultimate budget. So debt to income ratio is a maximum of 45% of your pre-tax income. And it looks a little bit like this. So we take into consideration the principal, interest, the property taxes, the insurance, the homeowner's insurance on the property. We factor in PMI or private mortgage insurance, and then the HOA. And let's just say that that was $2,000 per month. And then we take your other debts, maybe a car loan, student loan. And if those calculate out to maybe $500 a month, we take that $2,500 versus your monthly income of $7,500 a month. And that puts our debt to income ratio at 33%. Now, the maximum is 45% generally. For most first-time buyers, they feel really comfortable around 33 to 36%. So that's the goal. Everybody has a little bit, different threshold when it comes to debt to income ratio, but the maximum we can get to is 45% with qualifying. Okay, the next component to home buying is assets, and that's our savings. I think if you remember when we first kind of kicked off tonight's discussion, we talked about maybe two kind of challenges maybe first-time home buyers have. It can usually be credit, or it can be just resources around assets. There is assets that we have to verify for both the down payment and the closing costs, whether it's the 3% down and the closing costs. We just have to figure out where that money is going to come from. But there is some fantastic first-time buyer programs that we're going to talk about in just a minute. But as you're kind of figuring out what savings you have, this is some of the documentation that's needed for home buying. So generally need the last 2 months of your checking, savings account. Any type of large deposits, unfortunately, we're not going to be able to count into the calculation. Cash deposits can't be used because we have to paper trail everything when it comes to the home buying process. Now, potentially retirement accounts can be used, 401ks, 403bs, IRAs. You just want to be careful when accessing IRAs because you potentially can create a tax consequence for yourself. And then with 401ks and 403bs, usually you're taking a loan out against those asset accounts. So that's where that money is going to be coming from. So they won't create a tax issue, but you do have a repayment involved with 401ks and 403bs. And then gift funds can be also used. That's where a family member has helped gifting funds to help meet the minimum contribution for both your down payment and closing costs. There is a documentation process for that, which includes usually a gift letter. You got to verify the ability of the donor and then proof of the receipt of the gift funds. Now, in the state of Virginia, as well as other states across the nation, there is first-time homebuyer programs available through both the Virginia Housing and other agencies. I want to talk to you real quickly about the Virginia Housing Program, and that provides the assistance for both down payment and closing costs. There's flexible down payment options with the program. It also allows for gift funds. There's a grant program that's available for you. So it's really designed to help low to moderate income households. And so the first one is the down payment assistance grant, and it allows you to borrow 2 to 2.5% of your purchase price. And this is a grant. So when we think about the 3% down requirement, this would go towards that requirement of 3%. A grant, meaning you would not have to pay that back. The second program available is the Virginia Housing Second Mortgage Product, and that provides up to 3 to 5% of the purchase price towards the down payment and or closing costs. The rates for these programs are all set by Virginia Housing. And so let's kind of take a look at, what an example would look like using an assistance program. So let's say I bought a house for $350,000, for example. The minimum down payment is going to be 3% or $10,500. When I buy a home, not only do I have to save up for down payment, but I also have to save up for my closing costs. Closing costs can generally be anywhere between 2 to 3% of your purchase price. Now, in the seller's market we've seen for the last 2 or 3 years, most buyers were having to pay top dollar in closing costs, but that's starting to change a little bit. So where we were probably 3% a couple of years ago, or maybe a couple months ago, more likely, we're starting to get more towards the 2% level. But usually we would probably need about $17,500 to $21,000 out of pocket to buy at the 350 level. But if we took advantage of maybe the Virginia Housing second mortgage product, instead of having to come up with $17,500, we can get anywhere between $10,500 to $17,500, and that could be used to offset some of that out-of-pocket expense. So now maybe we're only needing to come up with maybe $7,000 to $10,000 for our home purchase, which can be much more attainable for a first-time home buyer than having to come up with twice as much money. The minimum down payment on the program is a 640 credit score, and then the maximum debt to income ratio that we just talked about is a 45% debt to income ratio. Now there is income qualifications, and they're based upon the county, which I'll show you in just a second. And then the maximum that they'll lend is up to 97% of the purchase price, which is the same as what a conventional loan will do. And then the down payment grant and the Virginia Housing Plus second mortgage are available to first-time home buyers only. So you can't be a second or third-time buyer. And just so you know, a first-time buyer is someone that hasn't owned in the last 3 years. Okay. So these are the income limits by county. So you can see Washington, Arlington, Alexandria has the highest income limit at 145, and then you can see the corresponding counties. So with these programs, we're going to be looking at household income, and so that'll be for each one of those counties, based upon where you're looking to purchase. Okay. So that's the Virginia Housing Program. Now I want to kind of talk to you a little bit about the buying process. So where do we go from here? And the next steps in buying a home is to, first of all, connect with us for a consultation. And so that's where we get a chance to design a home buying plan for you. The output of a consultation, which by the way, a consultation is usually about a 30-minute session over video. The output of that consultation is to be pre-approved. And a pre-approval certificate allows you to start going out and home shopping and making offers on properties. And so we've designed the 6 steps of home buying to give you kind of a visual aid of what it looks like to go from being pre-approved and qualified for your home purchase all the way to the very end of the process, which is called step 6 of closing your loan. So the first step, pre-approval, like I said, is a certificate that allows you to go out and start home shopping. That certificate gets presented to a seller of a home to show that all your financing has been validated. Usually that pre-approval certificate is good for 60 days. But if your home shopping process takes longer than that, we can always recertify your pre-approval at any time, and that's not an issue at all. So first step is pre-approval. Second step, which is usually the fun step, that's the house hunting phase. That's where we get a chance to do our online search or in-person search. Then now we know at that time what our maximum eligibility is in purchase price, so we can kind of look in whatever the desired areas, we can look at the right purchase price of home. Usually a realtor will help you with that process, and they'll kind of help navigate you through the different options that are available in your particular market. Now, if you find the right home, you decide to make an offer on a house, and let's say that offer gets accepted, then we're going to start the escrow process. And the escrow process means we have an accepted offer, and we're going to go through this process of doing our due diligence for you as the buyer, as well as us as the lender, and going through different inspection periods. And that launches with step 3. So seller has accepted our offer, and generally within a couple of days, we're going to have to make what we call an earnest money deposit. That's a deposit that's placed in escrow that shows our good faith that we want to move forward with this particular home. And usually your realtor will help you in starting inspections of the home. As a lender, we're going to order an appraisal of the house. And within a few days of that entering escrow, you're going to be receiving disclosures from us after we complete what we call as a follow-up video consultation. And that follow-up consultation allows us to meet with you over Zoom just to make sure your financing is designed properly. You feel comfortable with interest rates, payments, your out-of-pocket expense, maybe an assistance program if that's what you decide to utilize. So that's step 3 in the process. And then moving forward is step 4, and that's called processing and underwriting. And that's where our team verifies some of your application information, like your employment, your assets. Maybe some additional documentation will be required, because what we're trying to do is get you prepared to go to underwriting, so underwriting can make an approval of your loan. In this market right now, by the time we get to step 4, your interest rate would be locked in. And as I mentioned earlier, we will send disclosures to you that outlines the interest rate, payment, out-of-pocket expense. And then we'll submit everything to our underwriting team. And the underwriting team will approve our loan at step 5. And at that time, we're about 3/4 of the way through the process. At that time, our team will reach out to you, congratulate you on your loan approval, and you may have some additional items that are needed as part of the process to fulfill the approval. It depends on your structure of your financing, but usually you have a loan contingency, which indicates that allows you to do your due diligence on the house, get your loan approved, but your deposit is protected while you're in that contingency period. So at that time, at step 5, you'll be able to remove your contingency, and that tells the seller that you're comfortable with the due diligence that you've done, and you're ready to move to the final stages of the process. And with moving to the final stages of the process, we're going to issue to you a final closing disclosure. And why that's really important is because it's going to provide you a 3-day cooling off period before you can get to the very final stage, which is called closing your loan. And that's where you sign final documents. Those are done in person with a public notary that usually comes directly to you. After you've completed that signing process in person with the notary, you'll be wiring in any additional funds that are needed for your home purchase. And after that's done on our side, on the lending side, we'll do one more audit of all those signed documents, make sure everything's accurate, and then we'll wire in the funds for your financing, maybe assistance programs if you elect that. After that money is all reconciled by the escrow team, documents get recorded with your local county recorder's office based upon where you're purchasing in Virginia. That gets recorded, confirmed, and once we get that confirmation, then you become the official owner of the house. You get a chance to call your realtor, high five, and celebrate the huge accomplishment, because now you've reached the very final stages and now the official owner of the property. And obviously that's a huge accomplishment to make it through the home buying process. So a couple of slides here, I'll leave you with here. We have our earnest money deposit, so you can kind of learn a little bit more about what earnest money deposit is. And contingencies are, and I've kind of highlighted those a little earlier, contingencies give you the opportunity to do your due diligence on the property. Usually there's an appraisal contingency, an inspection contingency, which allows you to get the house inspected, and then a loan contingency, which I mentioned earlier, allows you to make sure you have your loan approved, and so you can confidently move to the final stages of the process. So, in kind of leaving today's workshop, we'd love to connect with the attendees of our workshop. And there's a couple ways that we can do that, whether it's an introductory call. So let's say you have some follow-up questions that you like to kind of have us review, or maybe you just have some financial questions that you want us to kind of talk through. Maybe it's credit, down payment, savings, whatever the case may be. Love to connect with you for an introductory call. If you're ready to take the next steps and want to do a consultation so we can design a plan for you, we have all the links here, including our online application, some of the typical documents that are needed, and then we can schedule you for either a video or phone call to help design some financing options for you. So whether you're looking to purchase next year or the next year or two, at least you can have a plan for home buying when that time comes. This is kind of what a consultation looks like for our clients. It's just a roadmap or a game plan to get towards home ownership. So we'll build that plan by, creating a budget and understanding what your affordability looks like, knowing where you want to purchase in Virginia, going through your application, your interest rate options, your out-of-pocket expense, your closing costs, walk you through the 6 steps of home buying. And the output of that consultation is to issue you a pre-approval. So whenever the time comes and you want to take those next steps for your home search, you can be able to do so confidently. We got some really great resources, including our mobile app that's available, and I really encourage you to download that if you get a moment. Allows you not only to do an application from your phone, but you can follow the progress of your loan. You can do calculations. It's a really great tool to take advantage of. You've probably learned already, especially as hearing about this workshop, in our partnership with VCU alumni, which, by the way, we just launched this year. We're super excited about it. Like I said earlier, this is our second workshop we've done with our VCU team, and really, really glad you could join us for this second edition. But we do also provide a discount in closing costs. clothing costs for VCU alumni, employees, and all our staff, which allows you to get a cheaper cost for your financing. So that's a really cool program. If you have friends, family, maybe colleagues that might be affiliated with some of our other alumni partnerships, they're also eligible for those as well. And the consultations that I spoke to earlier, those are free services we provide just to be a resource for you in designing that home buying game plan to move forward with. As I mentioned earlier too, we understand this is probably going to be one of the largest investments you're making in your lifetime. So we want to be a trusted mortgage advisor to help you on that journey towards home ownership. And so that's why we really want to try to give back in workshops like this to make sure like you're fully prepared to be able to take that next steps in home ownership. Here's all my personal contact information. So my email, you can text me on that phone number, and some of in our social channels. We love what our clients are saying about us. We have a lot of our clients that have recently purchased homes that we celebrate, kind of what their accomplishment looks like on some of our social channels. So I'd really encourage you to check us out on our Instagram, our Facebook, and some of our reviews that we have on Google and Yelp. But we're really proud of what our clients are saying about us and the experience they've had with us. And finally, this link here is just to schedule a consultation. If you want to, you can click right on that. That'll launch you into our scheduling tool. And hopefully we can get a chance to connect with you soon. I really appreciate everybody taking time out of a busy Thursday night. I know it's not easy to tune into a video call to listen about financial topics, but hopefully you found this informative for you as you decide to one day take those next steps in home ownership. So with that said, I'll turn it back to Tara. It's all yours. And I know we didn't get any questions as we're kind of moving through the slides, but we'll kind of hang on to answer any questions as we move through. Actually, we had a question come up just now. I'll go ahead. I'll take this question really quick if you don't mind.
Yeah, go for it.
So the question came in your opinion, which is better, a higher purchase price with a lower interest rate or a higher interest rate with a lower purchase price? So, everybody's situation is a little bit different. I think the perfect storm would be lower purchase price, lower interest rate. Unfortunately, in this market, we're seeing, higher interest rates, a lower purchase price. I think at the end of the day, I would probably go for lower purchase price just because you do have flexibility down the road where you can do what we call as a refinance one day. So maybe you're buying at a higher interest rate today, but maybe down the road, 5-6 years from now, interest rates come back down. You can always look to refinance at some point. That's a common thing that happens with existing homeowners. So even though you're buying at a 6% rate, let's say rates drop to 4% one day, who knows when that is, but you can take advantage of refinancing to a lower rate, similar to what you would see, happening with like an auto loan too. That's a good question. And then,
yes.
Okay, one more question came in. Same question, same person, different question. So is there a difference between local lenders versus national lenders? So there's kind of 3 segments of different types of lenders. So there's your big banks that you have. There's mortgage brokers, and what a mortgage broker does is they basically act as the intermediate between you, the consumer, and the source of funds, a lender. And then the other channel or segment is going to be a direct lender like we are. So we're a direct lender. We're national, but we have local presence in different markets. And so, the nice thing about, being able to, especially the way our world has changed so much doing video, we can work with clients on a remote basis, whether you're in Virginia or Texas or California. And most of our interactions are going to be done via video now. So kind of the days of local brick and mortar has definitely changed a lot, probably very similar to what you see in banking relationships too. But, I think at the end of the day, it's most important to provide a great, great product to our clients and an exceptional service experience. And so that's what we try to do, whether that's from our local market in Virginia or, here in California. So.
All right. Did anyone else have any questions? I didn't see anything else pop up. Well, thank you so much, Jason, for presenting.
Yeah, absolutely. Yeah,
our questions. This was a wealth of information, lots of information. So I hope, the attendees took some notes. And thank you so much for, whomever asked questions. They were really great questions. So if you guys enjoyed today's conversation and are looking to stay connected and attend other alumni events, feel free to click the link in the chat to access our calendar. And lastly, everyone who registered for the event this evening will be receiving an email with the recording. And then there will be a survey as well so that we can get some feedback so we know how to shape our events moving forward. So on behalf of VCU's Office of Alumni Relations and American Pacific Mortgage, thank you all so much for joining us and enjoy the rest of your evening.
Awesome. Thank you. Enjoy your evening. Good chatting with y'all.
All righty.
Okay,
Thank
bye.
you. Bye-bye.